On November 4, 2025, the world's financial markets were rocked, not by an earthquake, but by a calculated act of economic warfare. The People's Bank of China executed a massive, coordinated sell-off of $200 billion in U.S. Treasury securities, sending shockwaves from Shanghai to New York. This was no routine adjustment, it was a deliberate signal that the era of quiet financial codependence was over. Bond yields soared, with the 10-year U.S. Treasury note surging past 5%, a level unseen in over a decade. The move weaponized finance, shattering the long-standing Chimerica relationship that had stabilized global trade for decades. China's vast U.S. debt holdings, once a ballast for the world economy, became a weapon overnight. The sell-off was a geopolitical statement, not just a financial maneuver. For years, analysts dismissed the idea that China would dump U.S. debt, fearing mutual destruction. Yet Beijing pulled the trigger, and chaos ensued. U.S. equity futures plummeted, the dollar weakened, and borrowing costs for the U.S. government spiked instantly. The world watched as a financial battleship fired a warning shot at a superpower. Beijing's silence, after the initial confirmation, only deepened the panic. Markets speculated, was this the end, or just the beginning? China still held hundreds of billions more in U.S. debt. Uncertainty fueled fear, turning a financial event into a crisis of confidence. The global financial architecture built on the bedrock of U.S. treasuries suddenly looked fragile. The tremor from the east exposed a fault line beneath the global economy. The aftershocks were just beginning. The world realized that financial interdependence could be weaponized in an instant. The U.S. Treasury bond, once the world's safest asset, now looked vulnerable. The stage was set for a new era of financial confrontation. The New York Stock Exchange opened to stunned silence. Markets plunged. Dow, S&P 500 and Nasdaq all deep in the red. The VIX, Wall Street's fear gauge, soared to crisis levels. This wasn't about earnings or Fed policy. It was a direct response to China's financial strike. Treasury yields spiked, making all borrowing more expensive. Mortgages, corporate loans, credit cards. Investors fled stocks for cash and gold, but even the definition of safe was now in question. Major banks saw their values plummet, fearing a credit crunch. High-frequency trading algorithms amplified the panic. By midday, markets stabilized slightly, but the mood was tense. U.S. officials promised liquidity, but the old calculus was gone. America's ability to borrow cheaply was under threat. Wall Street faced a new reality. Its primary fuel, cheap capital, was no longer guaranteed. Why did China hold over $1 trillion in U.S. debt? The story began with China's export boom in the late 1990s and 2000s. As China sold goods to the U.S., dollars flooded into Beijing. To keep its currency cheap and exports competitive, China's central bank bought up these dollars, printing yuan in exchange. This left China with a mountain of U.S. dollars that needed investing. Only one market was deep and safe enough: U.S. treasuries. Buying treasuries recycled China's trade surplus back into the U.S. economy, earning a modest return and keeping American interest rates low. China became America's banker, financing U.S. deficits and fueling global growth. The arrangement benefited both sides. America got cheap credit. China powered its export machine. But this interdependence created a vulnerability for both nations. The financial loop was symbiotic, but also risky. Now that vulnerability had been exposed. The world saw how quickly trust could turn into a weapon. Chimerica described the economic engine powered by Chinese production and American consumption. For nearly 2 decades, China saved and lent, America spent and borrowed. Chinese capital suppressed global interest rates, fueled U.S. housing booms, and financed wars and tax cuts. The world took this low-cost capital for granted, but the relationship was never stable. U.S. critics decried lost manufacturing, while Chinese economists warned of overexposure to the dollar. The 2008 financial crisis rattled Beijing, prompting calls for a new global reserve currency. Over the next decade, China slowly diversified away from treasuries. Trade wars and rising tensions frayed the partnership. Decoupling became a policy goal in both capitals. The November 2025 sell-off was the violent end of a decade of eroding trust. Chimerica was over. The world's economic engine had seized. A new era of rivalry had begun. China's sell-off was more than economics, it was geopolitical strategy. It followed rising tensions over Taiwan and new US sanctions on Chinese tech. Unable to match US military power, Beijing opened a financial front. The move signaled that US actions would have real, economic consequences. Selling treasuries also fit China's goal to reduce dollar dependence and promote the renminbi. The freezing of Russia's reserves after Ukraine was a wake-up call. China feared its own assets could be next. By selling, China sought to sanction-proof its economy and move assets beyond US reach. The action also aimed to undermine confidence in the dollar, encouraging other nations to rethink their reserves. China's goal: reshape the global financial order to favor its own interests. The sell-off was both a warning and a blueprint for a multipolar world. The shock didn't stop at Wall Street. European and Asian markets plunged in tandem. US treasuries are the benchmark for global finance. A change in their value ripples everywhere. Emerging markets, heavily indebted in dollars, faced currency crashes and soaring yields. Fears of sovereign defaults spread, echoing past crises. The IMF and World Bank issued urgent warnings. Central banks worldwide faced a dilemma: hold treasuries and take losses, or sell and worsen the crisis. Commodity markets convulsed. Oil fell on recession fears. Gold surged as a safe haven. The global financial system, long assumed stable, was revealed as fragile. A single determined actor had triggered a global heart attack. The world's financial plumbing was more vulnerable than anyone realized. Trust in the system was shaken. The contagion was global, and the damage was just beginning. For Americans, the pain was immediate. Higher mortgage, car loan, and credit card rates. Home buyers were priced out, small businesses faced tighter credit, and recession loomed. Stock market losses hit retirement accounts, shrinking household wealth and curbing spending. The US government faced a fiscal squeeze: more money for interest, less for services. Painful choices loomed: raise taxes, cut spending, or borrow at punishing rates. China, too, suffered. Selling treasuries meant capital losses and a hit to its own reserves. US recession threatened Chinese exports and jobs, risking social unrest. The weapon had backfired, at least partially. Both sides paid a price, but Beijing bet it could absorb the shock better than the US. The gamble was on: whose society could endure more pain for strategic gain? The crisis forced both nations to rethink their futures. For the US, the era of exorbitant privilege was over. Fiscal discipline was no longer optional. Cheap money was gone. The shock could spur a manufacturing revival and supply chain reshoring. A weaker dollar might boost exports, but the US had to confront its debt. For China, the goal was to build a renminbi-centric financial system. Beijing pushed for global trade in yuan and alternatives to SWIFT. But the yuan faced hurdles: limited convertibility, capital controls, and lack of legal transparency. The dollar's reputation was damaged, but the yuan's wasn't yet secure. China's long game was risky. Could it build a credible alternative before its own economy faltered? Both nations faced uncertain paths. The global order was being rewritten in real time. The treasury sell-off marked the end of Chimerica and the start of a financial Cold War. Economic interdependence had become a battlefield, not a guarantee of peace. Both nations faced pain: America with higher borrowing costs, China with capital losses and export woes. The gamble: which system could withstand more hardship? The global economy was being reordered. America forced to pursue fiscal discipline, China racing to build a rival financial system. Other nations faced tough choices as the world split into competing blocs. The era of seamless globalization was over. Trust in the financial system was broken. The machinery of global finance had proven fragile. The world now faced a sobering question: can a stable global financial system survive in an age of rivalry, or is this just the first tremor of many to come?